Welcome to our introduction to Cumulative Volume Delta, an essential indicator for analyzing market dynamics. Cumulative Volume Delta, or CVD, is a technical analysis indicator that tracks buying and selling pressure in financial markets. It works by measuring the difference between volume traded at the bid price, which represents selling pressure, versus volume at the ask price, indicating buying pressure. When we calculate cumulative volume delta, we simply sum up the difference between ask volume and bid volume over time. This creates a running total that shows which side of the market, buyers or sellers, is being more aggressive. CVD provides traders with several valuable insights that aren't available from price action alone. It reveals hidden buying and selling pressure and helps identify potential price reversals. CVD shows market participant behavior that isn't visible in price alone, and it confirms trend strength and potential breakouts. In summary, cumulative volume delta helps traders understand who is in control of the market, enabling better decisions about trend direction and potential reversals. In the next section, we'll explore the formula behind CVD in greater detail. The calculation of cumulative volume delta is straightforward. Let's break down the formula. CVD is calculated as the sum of volume at ask minus volume at bid. Volume at ask represents trades executed at the ask price, indicating buying pressure, and is counted as positive. Volume at bid represents trades executed at the bid price, indicating selling pressure, and is counted as negative. Let's look at a concrete example with real trades to see how CVD is calculated. Trade 1 is executed at the Adding ask 5 price to with our a running volume total, of 5. Our CVD is now 5. Trade 2 is executed at Subtracting the bid 3 price from with
our
a
running
volume
total,
of 3. Our CVD is now 2. Trade 3 is executed at the
Adding
ask
7
price
to our running
with a
total,
volume
our
of
CVD
7. Is now 9. Trade 4 is executed at
Subtracting
the bid price
8
with
from
a
our
volume
running
of
total.
8. Our CVD is now 1. Trade 5 is executed at the
Adding
ask
10
price
to our running
with a volume
total,
of 10.
our
Our CVD is now 11. Now let's visualize how these trades contribute to the CVD line on a chart. We start with a CVD of 0. Trade 1 occurs at the ask price with volume 5, adding to our CVD. Trade 2 occurs at the bid price with volume 3, subtracting from our CVD. Trade 3 occurs at the ask price with volume 7, adding to our CVD. Trade 4 occurs at the bid price with volume 8, subtracting from our CVD. Trade 5 occurs at the ask price with volume 10, adding to our CVD. Finally, let's review some key insights about the cumulative volume delta calculation. When volume at ask exceeds volume at bid, CVD increases, indicating stronger buying pressure. When volume at bid exceeds volume at ask, CVD decreases, indicating stronger selling pressure. The slope of the CVD line shows the intensity of buying or selling pressure in the market. By tracking CVD over time, traders can identify shifts in market sentiment and potential price reversals. Let's examine how to interpret cumulative volume delta charts. CVD charts are typically displayed below price charts to analyze volume pressure alongside price action. When the CVD line rises, it indicates net buying pressure in the market. When the CVD line falls, it shows net selling pressure in the market. The slope of the CVD line indicates the strength of the buying or selling pressure. A powerful signal occurs when CVD diverges from price action. Here we see the price continuing to rise while the CVD is falling. This divergence indicates that despite the price increase, there's actually net selling pressure. This is a bearish signal suggesting that the price rise may not be supported by actual buying volume and could reverse soon. Key levels in CVD charts are points where the CVD line changes direction, potentially signaling shifts in market sentiment. Traders often look for these key turning points in CVD as they can precede significant price movements. Let's summarize the key points of CVD chart interpretation. Understanding these patterns and signals in CVD charts can significantly enhance your market analysis and trading decisions. In this section, we'll compare cumulative volume delta with regular volume indicators. Regular volume simply measures the total trading activity without directional information. In contrast, CVD tracks the difference between buying and selling volume over time, providing crucial directional insight. Let's visualize how these two metrics represent the same market activity differently. Regular volume simply shows the total amount of trading appearing as these vertical bars. CVD, however, shows directional flow. Green segments indicate buying pressure, while red segments show selling pressure. Let's examine a scenario where regular volume might appear neutral, but CVD reveals a strong directional bias. In this example, despite similar volume bars, CVD clearly shows accumulation by large players. Notice how the CVD line continues to rise despite price consolidation. Let's summarize the key differences between CVD and regular volume. By integrating CVD into your analysis, you can uncover hidden information that regular volume simply cannot show. Divergences between price and cumulative volume delta provide powerful trading signals. A bullish divergence occurs when the price makes lower lows, but CVD makes higher lows. Here, the price trend shows decreasing lows, suggesting bearish momentum. However, the CVD is showing increasing lows, indicating stronger buying pressure despite the falling price. This bullish divergence suggests that sellers are losing momentum and a price reversal to the upside may be imminent. Conversely, a bearish divergence develops when price makes higher highs, but CVD makes lower highs. In this example, the price is making higher highs, suggesting bullish momentum. However, the CVD is showing lower highs, revealing decreasing buying pressure despite the rising price. This bearish divergence indicates that buyers are losing momentum and a price reversal to the downside may be coming. These divergences provide valuable trading signals that often precede significant price reversals. A bullish divergence signals a potential upward reversal, providing a buying opportunity. A bearish divergence warns of a potential downward reversal, suggesting it may be time to sell or open a short position. However, it's crucial to wait for price confirmation before acting on divergent signals. Cumulative volume delta can be a powerful tool for identifying support and resistance levels in the market. When the CVD line flattens after a strong move, it often indicates price levels where buying and selling pressure reach equilibrium. Let's look at how CVD patterns appear on a chart with price above and CVD below. The price chart shows the market movements, while the CVD line below indicates the cumulative difference between buying and selling volume. Notice how the CVD line flattens in this area, indicating an equilibrium between buyers and sellers. This corresponds to a period of price consolidation, forming a support level. Similarly, we see resistance forming here as the CVD line briefly slows its ascent, showing temporary equilibrium before buyers overwhelm sellers again. Now let's explore how traders can use these CVD-identified support and resistance levels for making entry and exit decisions. Traders can use CVD patterns to identify potential entry points near support levels, particularly when the CVD line begins to rise after a period of flattening. Similarly, resistance levels identified by flattening CVD can signal potential exit points or places to take profits. Stop losses can be placed below support levels where CVD previously showed strength, providing a logical invalidation point. A strong rise in CVD can also confirm a price breakout, providing additional confidence in the trade. Let's look at a practical example of using CVD to identify trade opportunities. Here we have a price chart with a corresponding CVD pattern below. The colored arrows represent the CVD trend. Notice this support level where price consolidated and CVD flattened before rising. This presents a favorable entry point with a strong risk-reward ratio. Later, as price approaches this resistance level and CVD begins to flatten again, traders might consider taking profits or exiting the position. Let's summarize the key insights about using CVD for support and resistance identification. When the CVD line flattens, it indicates an equilibrium between buyers and sellers, often signaling potential support or resistance. Strong divergences between CVD and price movement can signal impending reversals at these key levels. Analyzing CVD across multiple timeframes can strengthen your identification of significant support and resistance zones. Always look for price reaction at these levels for confirmation before making trading decisions. In this section, we'll explore how cumulative volume delta helps detect market manipulation. Large market participants sometimes try to manipulate prices to trigger retail traders' stop losses or induce FOMO buying. However, these activities often leave footprints in the cumulative volume delta data that astute traders can detect. Let's look at a common manipulation pattern. Notice how the price and CVD initially move together, showing healthy market agreement. But here we see a divergence forming. The price continues to rise sharply, but the CVD fails to confirm this movement. This creates a false breakout, a classic manipulation pattern where large players push the price up artificially while their actual buying volume doesn't support the move. After luring in retail traders, the manipulators exit their positions, causing a sharp collapse as the price returns to levels supported by actual buying interest. To protect yourself from market manipulation, follow these detection guidelines. First, watch for price movements without corresponding CVD confirmation. Remember these key insights. CVD reveals true buying and selling pressure. While price can be temporarily manipulated, volume tells the true story. By monitoring divergences between price action and CVD, you can avoid false breakouts and breakdowns engineered by large market participants. CVD analysis effectiveness varies significantly across different timeframes. Let's compare how CVD behaves in short-term versus longer-term charts. On the 1-minute chart, CVD fluctuates rapidly, showing immediate market sentiment but containing more noise. The hourly chart filters out some noise, providing a clearer picture of intraday trends. Daily charts reveal institutional flow patterns and major trend reversals, with much less noise. A crucial concept in CVD analysis is understanding reset periods. Aligning your CVD analysis with your trading timeframe is essential for optimal results. Scalpers should focus on short-term CVD data, tracking quick shifts in buying and selling pressure. Day traders benefit from intermediate timeframes, balancing detail with clearer trend direction. Swing traders should prioritize higher timeframe CVD data to capture significant institutional money flow. To maximize your CVD analysis effectiveness, consider these key timeframe insights. Cumulative volume delta becomes significantly more powerful when combined with other technical indicators. By using multiple indicators together, traders can improve signal quality and make more informed decisions. Let's first examine how CVD works with price action, especially candlestick patterns. Here we have a price chart showing candlestick patterns with the CVD indicator below. Notice the bullish reversal candlestick at point 5. This large bullish candle after a downtrend is significant, but could be a false signal on its own. However, when we look at the CVD at the same time, we see a strong shift from negative to positive, confirming buying pressure behind the price move. Next, let's examine how CVD works with moving averages to filter signals and confirm trends. Here we have price action in white and a 50-period moving average in blue. Below, we can see the corresponding CVD indicator. Notice at point 7, price crosses above the moving average, a traditional buy signal. What makes this signal more reliable is that the CVD also turns positive at point 8, confirming increasing buying volume. Finally, let's look at how CVD pairs with oscillators, specifically the Relative Strength Index, or RSI. The RSI oscillates between 0 and 100, with values above 70 considered overbought and below 30 oversold. Here's the RSI indicator showing a move from oversold to overbought conditions. Below is the corresponding CVD indicator for the same period. Notice how the RSI reaches overbought territory at point 6, suggesting a possible reversal. What makes this signal more powerful is that the CVD starts declining after reaching its peak, even as the RSI remains elevated, showing diminishing buying pressure. To summarize, combining CVD with other indicators significantly improves trading decisions by providing multiple confirmations. Whether paired with price action, moving averages, or oscillators, CVD adds the crucial volume perspective that many indicators lack. Let's explore practical trading strategies using cumulative volume delta, starting with 3 effective approaches. The 3 main strategies are the CVD divergence strategy, the volume climax strategy, and the support resistance break strategy. We'll focus on the CVD divergence strategy, which identifies differences between price movement and volume behavior. First, we observe the price trend of an asset. Here we see a sustained uptrend. Next, we monitor the cumulative volume delta below. Notice that initially, CVD confirms the uptrend by rising alongside price. However, a bearish divergence forms when price continues making higher highs, but CVD begins to decline, suggesting weakening buying pressure. Let's examine the entry rules for the CVD divergence strategy. After identifying a bearish CVD divergence and waiting for price action confirmation, we enter a short position. We place our stop loss above a recent swing high to protect against adverse price movement. For our profit target, we aim for at least a 2-to-1 reward to risk ratio. Proper position sizing is crucial for risk management. Let's calculate a position size based on a 1% risk per trade. To implement this strategy effectively, follow these 5 steps. Identify the divergence, confirm with price action, set your entry, stop, and target, size your position appropriately, and then execute the trade.